One Up on Wall Street is a book in which Peter Lynch argues that ordinary individual investors actually have a significant advantage over professional fund managers. According to Lynch, successful investing does not depend on insider information or complex mathematical models, but on observation skills, common sense, and patience. The main message of the book is very clear. In the stock market, the advantage belongs not to Wall Street, but to the careful individual investor. Peter Lynch supports this view by drawing on his own experiences. As the manager of the Fidelity Magellan Fund, Lynch consistently outperformed the market for many years, and he argues that most of the best investment ideas are discovered not in offices, but in everyday life. When people shop, pay attention to the products their children use, or notice businesses around them growing, they are actually observing potential investment opportunities. Lynch's famous quote expresses this idea perfectly. You already know more than Wall Street. The book first addresses the most common mistakes investors make. According to Lynch, many people view the stock market as a casino. Expectations of quick profits, rumors, headlines, and short-term price fluctuations push investors toward poor decisions. However, buying a stock actually means becoming a partner in a company. If you do not understand a company's business model, products, and growth potential, you should not invest in its stock. The book again emphasizes the most frequent mistakes investors make. Lynch believes that many people treat the stock market like a gambling hall. The desire for fast gains, gossip, headlines, and short-term price movements lead investors to make wrong decisions. But owning a stock means owning part of a business. If you do not understand how a company operates, what it sells, and how it can grow, you should not invest in that stock. One of the most important sections of the book is how companies are classified. Lynch divides stocks into 6 main categories: slow growers, stalwarts, fast growers, cyclical companies, asset-rich companies, and turnaround stories. This classification helps investors set more realistic expectations. For example, expecting large dividends in a short time from a fast-growing company is not very reasonable, and expecting sudden price explosions from a slow-growing company may not be realistic either. Lynch draws special attention to fast-growing companies, but he also gives an important warning. Rapid growth alone is not enough. The company's debt level, profitability, and whether the growth is sustainable must be carefully examined. No matter how impressive a company's story may be, if the numbers do not support it, the investor is taking a risk. The importance of financial statements is explained in a very accessible way throughout the book. Lynch argues that investors do not need to drown in complex accounting details. Instead, focusing on a few basic questions is enough. Is the company profitable? Is its debt at a reasonable level? Are sales growing consistently? Is cash flow healthy? Companies that can clearly answer these questions tend to succeed in the long run. One of the concepts Peter Lynch emphasizes most is patience. According to him, many investors find the right stocks, but make the mistake of selling them at the wrong time. Panicking and selling after a small decline is one of the biggest obstacles to long-term gains. Lynch explains that a good company's stock may fluctuate in the short term, but if the business model is strong, it will eventually reflect its true value over time. Rather than trying to time the market, staying invested in the right company for a long period is a far more effective strategy. The book also highlights the futility of market predictions. No one can know for sure what will happen to interest rates, when the economy will enter a recession, or when the market will fall. According to Lynch, such predictions only create unnecessary stress for investors. What matters is not what the market does, but what the company does. If a company is performing well, market conditions are temporary. Lynch repeatedly emphasizes the hidden advantage individual investors have. Professional fund managers must move very large sums of money and therefore struggle to invest in small companies. Individual investors, on the other hand, can identify small but fast-growing companies at an early stage, before they are widely discovered. This is often where the biggest returns come from. Another key message of the book is that stories and numbers must be evaluated together. Lynch argues that relying only on numbers or only on stories is a mistake. A good investment combines a strong story with solid financial data. What does the company do? Why is it growing? And how is that growth reflected in the numbers? The answers to these questions form the foundation of a sound investment. In the final sections, Lynch teaches investors how to deal with fear and greed. When the market falls, panic-driven investors usually make their biggest mistakes. In reality, market declines create opportunities to buy good companies at discounted prices. According to Lynch, the stock market is a place where money is transferred from the impatient to the patient. In conclusion, One Up on Wall Street is a powerful book that shows investing is not a complex game reserved for an elite group, but something careful and informed individual investors can succeed at. The core message of the book is this: big gains do not come from bold predictions, but from simple observations, solid analysis, and long-term patience. You do not need to be smarter than Wall Street. It is enough to understand your surroundings and invest wisely in companies you know.